Welcome back, everyone. Sorry about traveling again. I'm out here in New York again and enjoying the nice weather. Um, I'm sure Florida's a bit better, but got to get out of Florida sometimes to go visit people. So it's been a good week, busy week. We'll be back, I think, to our regular Friday morning schedule next week and for the foreseeable future until I travel again, maybe. Uh, some good tweets this week. We'll get into some of that. Indices. I'm on the warpath against stock indices or any kind of indices. I've been hemming and hawing about this as far as the limitation that they could have on producing outlier trades, but also I don't like them because they probably even more important or equally as important. I just can't get over the fact that some of these indices we would be long some of those markets, short some of them, and flat some of them. And I just think they're not that legitimate to trade. But I put that out there, and Absolute had a good comeback, which I liked what he said. um, so we'll get into that a bit, I guess. And then, oh, yeah, there's some other good tweets I want to comment on. Richard had a very long tweet thread which he should talk about because that would be really nice. Every time the spaces comes up in discussion, my friends tell me how much they enjoy Richard. Okay, Oleg, are you ready?
Yes, I'm ready. Hi, Jerry. Hi, Richard. Hi, Bruno. Hi to all. Hi, Michael Harris. Hi, all the guys, Jerry Smith and other guys. I'm very happy to see you all. I'm very happy to be here, and I'm sure that I'll always be happy to be here. I'm absolutely sure. And I'm now in nice forest. I'm also enjoying weather, but I thought maybe 10 minutes ago that I enjoy our discussions more even than weather, even the best weather in the world. I enjoy our every discussion more. So I want to say that I was very impressed by the Fill the Gap podcast episode number 28 with Jerry. I did 20 notes, and it's very insightful, very wonderful, and I think every note, every sentence from this note can make a trader a better trader, and maybe even a better person, a more successful person in all areas of life. So it's great. Into one of the greatest discussions ever I have heard in finance, I think. So I was very impressed and did 20 notes and already published these notes on my profile. So let's get started our conversation. I'm very happy that it's starting. Of course, was waiting for all week every day.
Yeah, last night at dinner, my friends were telling me how much they enjoy Oleg and how much they missed Bruno. I'm like, I know. I missed him too, but he's back. How are you, Bruno?
Have some communication issues right now. I'll be back in a minute.
No problem. No problem. All right. Well, let's get into our discussion. Unless Richard wants to say good morning and good evening. And how's it going down under?
G'day, Jerry. G'day, everyone. I'm glad to see Bruno's here. I just found it difficult hearing him. But, yeah, all good down here, Jerry. The winter, with winter is slowly coming here. You're probably getting summer up there. So, we're starting to get cold in the mornings. But, yeah, all good here. Looking forward to the spaces tonight, hearing what people have to say. Looking forward to hearing that conversation you had with Absolute. I missed it this week, so I'd be interested to know the guts of that content you had, that discussion you had with him on the tweets.
Right. So I was sort of just going off about trading stock indexes and how much I dislike trading them. And And his response was pretty good. I liked it. I mean, I don't think there's much of a justification for trading um, indices, but especially if you can trade the single stocks. He asked me if they were profitable, the indices are profitable. I said, well, the single stocks are more profitable, especially risk adjusted, on the downside, because you're kind of peeling off, you're changing your exposure, due to stop losses and due to trading stops. And so the drawdowns are especially better. When the stock indices, they had their really day in the sun, with the FANG stocks driving the performance so great on the upside. And making sure you had those stocks was probably pretty important. And they were sitting right there in the S&P. But I'm still going to. I think the biggest thing to remember is that you would never trade a basket of anything else, a basket of grains, where you could be long, short, or flat, corn, beans, and wheat. Uh, no, you would. Right now I'm long beans, flat corn, and short the heck out of wheat. So that's much better than trading a basket. And I think, and I don't even think it's legit, to tell you the truth. I really don't like it. Okay, so he says if indices are profitable, then they're legitimate, or why not trade both? So I'm like, oh, okay, yeah. Is that true? If it makes money in the back test? Well, it made money in the back test. There could be a lot of things that can scooch through the back test and look pretty good. Okay, then he says global portfolio of indices covers macroeconomic factors. Narrow focus single stocks cover single country microeconomic factors. Large cap stocks are indices of their various businesses. I like that. I sort of agree with that. I pretty much said that. And that's the reason I don't want to trade them on the upside. I don't want to have a portfolio full of large companies with lots of diversification where the fundamentals that might hit a certain business that they're in may not produce an outlier because of the size and the diversification. Yeah, so I'm sympathetic to that. I think that's, and then probably shorting them is, better than shorting indices, and probably for other reasons better than shorting smaller stocks. The larger stocks in the indices, the big edge that they have is they have a lower ATR. And so you can put on a bigger position and make more money on the shorts, let's say. And I guess it's going to have an impact on the longs as well. I don't think it makes it right. But yeah, I guess he's not here today. But it was pretty interesting. I'm pretty set on my single stocks. And I trade so many single stocks, and I have such a diverse basket that it actually improves my portfolio. And it's not just about stocks. Some of my stocks are long, short, and flat. And they're working out pretty well now. And as I've said many times, I have more diversification in the stock sector than I do anywhere else.
Yeah, that's interesting points, Jerry. And yeah, I agree with nearly everything you say there. But look, my concern with indexes or indices is that we're not in control of diversification when we're dealing with an index. In other words, it's let's say it's the S&P 500 or it's the Dow Jones or whatever. That's a committee that has been charged with the responsibility of forming that index. And we know that the nature of the index is a system in itself, in that it's selecting, say, the top 500 companies by cap weighting. And it's a long-only bias that's sort of the system applies to that index, in that the weaker companies fall out of the index as new, strong emerging companies come into the index. So diversification really is taken out of our hands by a committee and the process itself. And I feel that with our method, we want diversification in our hands. What we're trying to do is we're trying to identify these uncorrelated return streams, long and short, that when we compile them in our diversified process, gives us a bang for buck with our particular method. But when we are deploying someone else's method of diversification, whether that's an index or it could be an ETF as well, that's another sort of entity or another sort of liquid market where we really lose the power of diversification. It's taken out of our hands by whoever constructs that ETF. I personally like having the control over what I diversify into. So there's those issues, and also there's the long bias of the process used for equity indices, which naturally makes the systems deployed to target that index different to the systems we deploy for the universe of other markets we trade, by virtue of the fact that the process of the index itself is applying different rules to what we're applying with our methods. So there's all of these factors that I think compromise our ambitions for our simple, robust systems and our particular faith in our process. They start compromising that, eating away at the edges, making it less robust. And I listened to a really good podcast this week. Just trying to think who it was. I think it was a Ferris podcast on a gentleman who came from Boston Consolidating Group, BCG. A lot of experience in looking at companies. He was looking at private companies and public companies. And he started looking at diversification. And, a diversified company, of course, once again, is taking control away from us in terms of the diversification we use for our models. So when we, invest in a highly diversified company, we're already sort of significantly diluting the potential tails that occur in that return stream by virtue of the fact that the company itself has sort of smoothed out their performance record by their diversified processes that they deploy. So there's another reason why I don't like investing in highly capitalized, diversified companies that are already diversified, and much prefer looking at idiosyncratic companies. In other words, companies where they can be strong success or strong failure, or it's the same as in commodities. When we're going long and short, we're looking for both directions, for our opportunity. But there's some of the things I'm thinking.
And I want to say that even we have discussed already that even if we are trading two highly correlated asset classes, like maybe silver and gold, diversification adds value, and even if they are very correlated, we can see maybe different signals. One stop can be hit, and the second stop, initial stop, for example, cannot be hit, and the trade goes and catch the outliers, for example. So if we trade an index, we lose this opportunity to diversificate. We lose this opportunity to be a better trend follower. So if we have an opportunity to trade the markets, a broader portfolio, single stock markets, of course we must do this.
Yeah, why not create an index for other sectors in your portfolio? I got a notice from IB the other day. I mean, maybe I'm behind on this, but they were saying we can create your own index for you. You just tell us what you want the index to be and how you want it weighted, and we'll do it. Well, if stock indices are so wonderful and great and acceptable, then just why not create a grains index? It would just make life so much simpler, and a currency index, the way you want it, or create the dollar index. A while back, I was asking Richard about trading these indices, and he brought up a good point. I think we've talked about is, at some point when the market gets like COVID or 2008, when you get just a tremendous downtrend and every stock goes down, all of these stocks will become highly correlated. And this index is just the perfect thing to be short, because, some things have been in a downtrend forever. They're probably not going to go much further. And some things were flat or even long, making all-time highs before COVID. And then all of a sudden, so you're shorting effectively markets in a big uptrend, and so you can close your eyes and not be offended by this, and just say, well, I'm trading the index, and it made a downside breakout. I'm not closing my eyes. Okay, so I'm not going to do that, and I'm going to get these things off my portfolio as soon as I can, and I'm going to concentrate just on finding individual stocks to short with, pair them up with my individual longs as well. I just don't really like ignoring when I know better that these are not good trading vehicles. And, as I've said many times, I'm going to continue to trade a lot of single stocks, pair that with futures, currencies, commodities, and bond markets, and put that into an ETF. And I'm going to put trend following number one, and trend following all these great markets the way they should be, versus managed futures, which, managed futures, CTAs, they trade indices. Why? Because they're futures. Give me a break. So I remember going to our biggest client one time and asking them, could I put single stocks in their portfolio? And they were like, no, you're a futures trader. And then single stock futures came out, and they said, sure, you can trade single stock futures because you're a futures trader. So it's really a shame and bad that the industry accepts this and doesn't offer clients something far superior. Jerry, who's in the spaces, he asked a question this morning about single stock futures, and we traded those for a long time, and they were never liquid, but if you traded the largest stocks, you could do kind of an EFP. So you kind of do the trade in the cash market, and they would convert it to a future. But they kind of lost popularity, and they kind of went away. I think they may still be around in Europe, but I think they sort of got torpedoed by the big stock trading firms as well, because it was going to be money out of their pocket for clients to buy stock futures rather than going through the big wirehouses and big brokers and paying them the interest rates you'd pay to get leverage on the stocks.
Hi, Jerry. How are you? Can I ask you a question about that? Do you remember if the margin that they asked you in those futures was substantially lower than the ones that you can get, for example, by getting money from IB, etc.?
Well, it was not based upon risk in the market. So the margin requirements for futures contracts are usually going to be based on the volatility in the market. So many times, if a market is limit up, for 2 or 3 days in a row, the exchanges and will increase the margin. The single stock futures was a flat, I think 20% of the cash value. So right there, it's kind of goofy and screwed up. I'm not sure why they did that, but once Chicago held on as long as they could, but the prime broker network was just too strong and wasn't able to. They eventually got rid of the single stocks, but you can still do a synthetic future by buying a call and selling a put at the same strike price. And so, synthetically, those, you can kind of create your own future, but you pay in double commissions, a double bid offer.
Thanks. And I also wanted to ask you something, because on the other side of the index is the single stocks. And when I hear about trading single stocks, besides being operational, very much more complicated because there are a lot of them. The main issue I have with them, and I didn't research it, but it's just a feeling, is that whenever I hear somebody who is trading single stock, there are always names that I also listen to in Twitter, in the press, etc. So my main concern about single stock is the selection bias. I don't know if I'm right or wrong, but when I hear people trading single stocks in trend following, there are always companies that I know of, and there's almost never, I think, a surprise, like what is this obscure company that is it's getting traded? I guess it has to do in the beginning with volume and liquidity and size. I guess that, but since there are so many of them, how can you avoid not trading something that you listen to in Twitter or you're interested in, etc., and not being, getting rid of that selection bias?
Well, I'll tell you what I do, and then you can tell me if I have some selection bias, because I'm not sure if you and I, if I know what you mean by that. So I choose the stocks based upon liquidity and diversification without regard to a back test. So I don't back test the stocks. I just choose them from different industries. They're somewhat obscure, and you would laugh at my list because it has no stocks on there that are, well, there's no large companies. I try to pick the ones that have, there's a peanut company, and I think they're kind of like 5 billion market cap, and that's all they do is like peanuts or nuts, right? And so they're marijuana companies and a psychedelic mushroom company. So Tootsie Roll, I added Tootsie Roll this week. That's a chocolate candy I used to eat when I was a kid. So now I think then here's the other big point, and that is I don't change the universe. So it's a fixed universe. There was one tweet a few days ago I commented on where hedge funds are trying to find bank stocks to short, right? And this is what everyone does. They try to find something to short. They do this analysis, or it hits the internet, and so they're trying to find something to short. And we always talk about, well, add a bit of trend to that. Short it when you come up with your thesis, quote unquote. Then wait to the downside breakout maybe, and then take a small loss. And so my point on both of those is we don't do that. If it's not in my portfolio, I'm not going to go short. And if it's in my portfolio, I'm going to go short. So if I didn't have banks in there before SVB, then I'm not going to be short the banks, a bank. Okay. So we don't do it that way. We keep the portfolio relatively fixed. I have 3 stocks out of 150 now that are takeover. They're going to be taken over. So they're off my list. I got to find 3 more. Okay, so that's unavoidable. Tupperware I had. It's another thing. My mom used to buy Tupperware. That's why I put it on there. And it's going out of business, so I had to take that off. And then sometimes the stocks, they just go no liquidity. They go to $1. Wheels Up is like 10 cents. And so they may have to come off as well. But I think the key is you don't take them off the list and you just trade them. And another comment I wanted to make is that I don't think it's good advice to tell people to add a dash of trend. I just don't think that that's good advice. I mean, I'm not even sure it's better or worse. I think it may be worse than ignoring trend. If you've got some sort of idea about how you're going to trade and it's not full-blown, full-blast trend following, then I'm a little hesitant to say, well, add in some momentum and then take a small loss. I don't know. You can't, if you don't have a fixed universe, yeah, that's no good. If you have more than one exit, that's no good. If you're not treating all markets the same and the longs and shorts the same, I don't know. I don't know. It's no good. So you need to buy in and understand the whole trend following package, implement it, love it, believe it, become a trend follower, or, I'm not sure I should give you any advice. What do you think?
Well, I agree with you, although I committed that sin in the past. For example, trading Argentinian stocks. There were some companies on a portfolio that were bought because of the business, and they wanted to select a criteria to exit them, and for that I suggested some kind of trend following mechanism to exit them, because I really didn't know and couldn't know what to expect from a company that has a business in any emerging markets, but especially in Argentina. So we ended up using something like a moving average or something like that to exit. And regarding your comments on single stocks, well, maybe, as I said, it's something that I guessed, but maybe you're proving me wrong, meaning that you have many unknown stocks in your universe. And I agree with you that it's great not to fool around with the universe and maintain it as you made it. And I guess it has to be as random as possible. But again, given that we always put a minimum volume criteria or something like that, looks like, maybe I'm wrong, that we are starting to select from something that already had a lot of momentum, so it became big and it became interesting to people to trade. I don't know if I make myself clear enough.
Yeah, I mean, I get it, and but I really, yeah, I don't know. I don't know why. I think, I think keeping it in the portfolio and not taking it out. I don't know. For some reason, I think that might um, help with getting rid of the bias. But then again, how does it differ? Like, and I've said this many times. Like, um, I mean, I think I've said kind of that it's kind of silly that for most like CTAs, they trade whatever the CME gives them. Here's what you're going to trade, because you're going to trade crude, heating oil, unleaded, because we deem it, and you need to trade it. And so whatever CME and ICE give us, we trade it, and we don't even ask any questions. So because we get we have to make a choice. We can't trade 5,000 stocks, 1,500 stocks, or we don't want to. So we make a choice. Do we need to make a random choice? Or is it okay? And some people trade 55 or 60 futures markets. And so they, by definition, have gone in and said, I'm not going to trade Brent and crude. I'm going to trade one or the other. I'm going to be more concerned than Jerry is on setting up my portfolio without these overlapping, highly correlated markets. So did they exert some sort of bias? So I think we should treat the stocks the same as the futures. And if we have a criticism of bias in the stocks, we need to examine how we chose the futures as well.
Yeah, you're correct about that. I think that I'm in the 40-50 range, and to be fair, it's because of the volume. It's because of not trying to avoid having any problems with gaps and liquidity, etc., which maybe isn't true. Maybe it's a concern that it's not necessary. But I agree with you with that. But you know, I always, and there's another thing that maybe it's just an impression, and maybe I'm wrong. I always, when I hear about single stocks, I hear about things like Moderna, Tesla, etc., and I never hear about things like McDonald's or something, Walmart, etc., which will be maybe good. Of course, they're all big, but so is Tesla. But there could be good businesses. Maybe there, of course, you will have very big positions because of their low volatility, their low ATRs. But it's something that I kind of sense, and maybe I'm wrong. Maybe you also trade McDonald's, and you also trade, I don't know, Fastenal or things like that.
Kojira, I had a pretty fun exercise where I asked ChatGPT. I said to it, I was just playing around with ChatGPT, and I said, refer to the constituents of the S&P 500. And then I said, select the 10 most uncorrelated stocks using logic as a basis for your decision. So ChatGPT went away. It decided that its logic, there was three points it was looking at for its uncorrelated series, and then it pasted 10 selections from the S&P 500. Then I asked it to review the data, and it used the available data that it had in its history. And I then said, validate whether that logic is in accord with a correlation analysis. It then came back saying, well, yes, it is validated. The logic works well in accordance with the correlation statistics generated from the selection. And then one other smart cookie decided to look at those 10 stocks it selected and ran a back test for the last 20 years and saw that it outperformed the S&P 500 using those 10 just on a buy and hold approach by 2 times. Now, the interesting thing about ChatGPT is, you, for instance, you could use it as a tool for the selection process because it would be a very sort of arduous task to have to go through all the constituents yourself with the S&P 500 trying to work out, well, is this uncorrelated to that or whatever. But using something such as ChatGPT might sort of streamline the process. But I was quite surprised at how rapidly it selected the uncorrelated suite, and it gave its reasons for doing so. What I'll do is I'll post the thread that I did for this at the bottom of the Spaces recording that we do tonight. But it just blows my mind as to how we could possibly use ChatGPT in our selection process.
Yeah, that's great. I mean, if I do it myself, what I would do, if I do it on the cheap side, I would buy something like CGI, etc., and I will start filtering by value traded, and try to make random portfolios from that selection on whatever is there. I like the idea. I don't know if it was you, Jerry, to ignore names and just look at the stocks as numbers and not companies with names on them, because that means that you're not able to understand what the future of them will be. You cannot fully understand the companies especially in the future. So what I would do is, I buy one of those companies that have all the historical, even not in the S&P companies. I try to make a filter of value traded, and I try to do random portfolios on that one. And I guess that one of the main key issues would be which is the amount of $1 million of daily trading value that I will put on it. My guess is that will, maybe I'm wrong, but my guess is that will make the results very different.
Jerry, I've had some fun. By the way, good morning, guys, and good evening, Richard, and especially hello to Forrest occupying building. I've had a lot of fun with my single stock experiment. When I first heard of trend following, I had to learn it, and I did through Cavell. That was a few Thanksgivings ago. And I bought the CSI data package, but I had no business trading futures myself, commodities, currencies, credit markets. In fact, I don't even have any business shorting because I don't know how to do that. But I wanted the trend following experience for myself. So of course I bought some done, and as I've said, Jerry is my largest holding in my retirement account. And by the way, I'm still talking up, sharing about, and looking forward to the TFPN ETF, Jerry. So come on, summer. We've got capital to deploy, and we're excited. But while Jerry and Don and a Standpoint are having their fun, and I've invested with them, Mount Lucas a little bit, I wanted my own trend following experience. So I decided to do fractional dollar entries for single stocks. And so right now, as of this morning, I have 360 single dollar holdings of stocks from a 5,712 universe that I got through CSI. Yeah, I took 15,000 and then I shoved it down to about 6,000, so it would fit inside of my 7,500 subscription for $300 a year. And so far, since September, my open equity is up 13%. And every day I tend to my garden. I get rid of certain ones that aren't ATR achieving, and I buy the new ones. And I run my scans. And as Gunnar was sharing about selection bias, I look for those that have 500,000 or more shares traded today. And And then from there, I look back to see, okay, the average volume for the past year is also above 5,000 or more shares. And that's my criteria for getting in on a 200-day high. I have yet, since the end of September, had an authentic exit on my metric of 150-day on a low. Thanks.
Yeah, I don't have as good a luck as most people with ChatGPT. I don't like using ChatGPT so much because it ticks me off that the data goes through only through September 2021. So I use Bard from Google, and both of them though give me wrong answers frequently, and I call them out on it, and their response is, "Oh yeah, sorry about that." Okay, so it's annoying. Um, But I definitely was listening to a podcast yesterday when people were talking about needing to practice and knowing how to ask the AI programs the correct questions and leading in the correct order, kind of leading it to help you make a better, come up with a better answer. Um, so, yeah, hopefully, but I do, use it just to, like I read an article this morning about gene modified vegetables. Like this is maybe a new thing coming out, and so I just plugged into Bard. What are some of the companies that are involved in gene editing of vegetables? And so, it just takes a long time because it just gives you wrong information about are these companies publicly traded, and it'll say yes, but most of them usually are not, and it's kind of I don't know how to get. It seems like a pretty simple question, but I'm not. I'm getting a little frustrated with these programs, but I'm just using it on a very elementary level, I guess.
You do have to validate along the way, Jerry, and make sure also that you're using the latest engine if you can. So rather than 3.5 on ChatGPT, try and use 4 if you can. But definitely validate all of the responses it gives.
Jerry, can I ask you a question? Sorry.
Go on.
Can I ask you a question? Thank you. When you are, because the main issue, for example, with doing a back test, etc., is the shorts and slippage missing there, and you have to do something. But when you actually do shorting on companies, when you have to get from the market, etc., if that doesn't work, do you do any kind of substitution? Meaning, okay, I couldn't short this company, so I will short the index or I will short the ETF or something like that, or you leave it at that, and maybe you won't have that short, or you will have the uh, or you will be like passed over by a gap against you, etc., and that's all right for you because of the size of the trading size that is small.
Well, I've already told you my secret, and I told this to someone really adept at trading, and I said I have a bad thing to confess, and I tried to explain it to him, and he kind of was okay with it at the end. But I have a long list and a short list. So my long list is the small companies, and my shorting list are just the largest companies. So I just take the list of the 150 biggest companies, and that's my short list. And so they're easy to short, and there's lots of shares to short, and the fee for shorting is really small. Sometimes the fees for shorting in ETFs can be pretty high, and then they fluctuate depending, I guess, on availability. But so I think that is if someone criticized that idea of not going long and short each one of these stocks on my list, I would not. I don't have a good answer for that, but that's what I'm doing currently: shorting the big ones, going long the small ones. Yeah, and so I'm usually more strict than that by obeying all the rules, but I'm definitely not obeying that rule. But I guess I admitted earlier that I also shorted indices and I didn't go long indices. So I'm just sort of replacing indices and ETFs with shorting large cap, mega cap, 20 billion and above. What do you think about that?
Oh yeah. First of all, sorry, I didn't want to to ask you things that you already answered, and maybe it's your thing. I think that it's a great way of looking at it, and it's a practitioner's way, and I think it shows that beyond everything, most of the time we are worried about liquidity issues against us in every possible way, being getting stocks, getting gaps against you, etc. And that also it still keeps a huge place in the decisions besides uh, going after the outliers. In my experience, in my current reincarnation, so to speak, I'm much more worried than you, I guess, about lack of liquidity, etc. And that's why I keep it at 40-50 and I don't go into single stocks, but it remains an important thing to keep an eye on.
Hi, Jerry.
Michael, how are you?
Fine. Good luck with your ETF. Good morning, everyone, or good night, depending on where you are. Good luck with your ETF. Will be finally the way to replicate you. And I don't know if Andrew like that. So anyway, about trading stocks, my analysis says that it doesn't add any value to a trend following program, but it may be a wrong analysis. And I would like to ask you if you can be more specific, because I'm a numbers person. And I want to really find out whether your decision to trade stocks is driven by liquidity constraints. Because when you introduce specific asset risk to a portfolio, you must have a very good reason for doing that. And if possible, I would like to ask you, since 2010, for example, how much the long stocks and the short stocks have contributed to your annualized return, which is exceptional, by the way. And if you hadn't traded any stocks, would you have done any better with only the futures, or the stocks made the difference? I mean, I can't just accept a narrative about trading single stocks. I have to see real numbers. And my numbers say stay away. Okay.
Okay, well, I think it's very difficult to. This is one of the very hard things because 99% of the CTA industry trades indices. So you can compare everyone. But if you're really no one's going to have the same portfolio as me. Another CTA who wants to trade single stocks is going to have a different portfolio. There's too many to choose from. And I'm hunting outliers. Now, very few managed future CTAs hunt outliers. They reduce those positions. It's just a given that that's the way the industry does it. Is if the volatility doubles, triples, quadruples, you reduce your position regardless of what's all-time highs, you get out of some because the volatility of that particular market increased. And there's correlation management as well. So, of course, I've said before that I happen to have Moderna, Tesla, Zoom in my portfolio over the past few years. And of course, they made a huge difference. I'm hunting outliers. I'm not going to be that great and because I'm not trying to make the most amount of money that I can in a sector move. I make money when the sectors go down, like the short bonds. And I've said, like last week, well, was there any major outliers in that big bond move? I'm hunting them. That's all I'm really caring about. I'm grateful for the profit that when the whole sector moves. Okay, so maybe there was a couple of short-term interest rates that did a lot better than the 10 years. But yeah, so it depends. The numbers are going to depend upon, what did you have in your portfolio? I have orange juice and sugar and Robusta coffee. Okay, there's large CTAs who don't have those markets. So if you look at Jerry's portfolio, trend following works. If you look at someone else's portfolio, trend following doesn't work, and vice versa, right? So it's really difficult to because if you're hunting for the outliers, you've got to have that outlier in there. If you have it, you're like a genius. And if you don't have it, well, what's wrong with you? Well, you can't trade all the markets, and I might not get any stock outliers this year. I got my fair share in 21. Some of the CTAs, this was a recent paper I tweeted, or maybe it was a podcast where they'll talk about doubling down on being servants of the traditional portfolio. The whole mantra of allocate 5 or 10% to CTAs for crisis alpha to help you with your traditional assets. So they double down on that. They propose to clients, how about no stocks? Yeah. Limit the beta. And this is supposed to be a good thing. And so making your performance worse, because they go on to admit, yes, we do that for some clients. Yes, we're willing to do it. However, performance will be worse if we take the stocks out. Of course it will. If you eliminate the currencies, performance will be worse. And the commodities, performance will be worse. So if you eliminate any kind of major sector like that, it should be worse. You're getting rid of some outliers, plus you're limiting the diversification. And it's going to be bumpier, and you can have a chance to have bigger drawdowns. So there just shouldn't be any controversy over, look, we went 10 years or longer, probably longer, that the grains made no money. I was in this house when I was looking at research reports, probably 5, 6, 7 years ago, and I called up my research guy and I said, we haven't made money in soybeans in how long? So these numbers are the truth that these numbers put out can be hard to understand. How could you only the trend followers are going to trade a market or a sector that hasn't made money in 10 or 15 years? But look, part of the reason for the lost decade is that the CTAs, the trend followers, didn't have much of a commitment to the only group of markets that were going up. The best trends of all time were in those stocks. And we dicked around with these stupid indices, making sure we didn't have too much of the indices on. And there was a sector that was doing really well, that if we'd have traded more of it in more single stocks and hunting, very material impact on our performance.
Hey, hi everyone. Hope you can hear me well now. Thanks for the warm welcome, Jerry, in the beginning. I'm really glad, especially because this spaces and the talk with this community is so important to me. I've been out for a couple of weeks because I'm trying to set up my own trend following program here in Brazil, and man, it's difficult. It's far from easy. I can tell you that. But well, let's talk about the good stuff. Um, this talk about trend following stocks reminds me of a conversation we had in the beginning of this spaces, perhaps in Clubhouse, um, about our expectations with each individual market. And at the time, I had a take that um, when you apply a trend following filter or a trend following program over any asset return stream, you get pretty much the same thing. You get you can expect a 40% hit rate. You can expect a 3-to-1 win to lose ratio. You can't expect anything much different than that. In a way, trend following kind of standardizes everything. So if you're applying your trend following system to stocks or to currencies or to commodities or whatever, it doesn't really matter in the long run, because the program will make it profitable. Will make anything like that profitable in the long run. What we do to avoid getting crushed is to trade a lot of markets in a way that we can survive until that long run arrives, and we can reap the benefits of the trend following program over time. So when you're trading stocks, I see value there, and this argument that stocks is what it's the sector in which the trends were on for the last decade. That what explains the bad CTA performance over these years. And I'm full on this idea of trend following stocks. What hinders me right now it's just the limitation of what I can access in the American markets. And in Brazil, I believe I can trade trend following stocks. I haven't really studied it, especially because the companies here are pretty similar. So trend following 50 stocks in Brazil, it's pretty much like trend following just one stock, and with a huge bet in this one stock. It's pretty much Brazilian risk. Everything here goes about the same direction most of the time. Thanks. Oh, and one last thing. I'm glad you're recording that podcast with Mike Melasinos. I'm binge listening to that for the last days. It's amazing. Thank you very much for that.
Oh, thanks, Bruno. Yeah, we have fun doing that. I think it's kind of fun, and we're good friends, and it's short, so we don't want to make it too long. But hopefully it'll get better, and we'll get better at that. But yeah, that's one of the things that Richard brings up a lot, and I certainly believe, and that is these markets. All of these markets have this quality of being able to produce a outlier. It's inherent in the markets. I'm not sure it's inherent in the indices as much. We've talked about that, but it definitely, and I don't really think that, I've said this before as well, and that is, I don't think that anyone should pay too much attention to me saying, I have this magic formula of let's go long the small ones because they're not as diversified and go short the big ones. I think there are plenty of stocks. I mean, when I went, I have to admit this, when I was long Tesla, way back when it first broke out in like 2020, I think, the ATR was, I think, 87 cents. And I had a gigantic position on, I'm pretty sure it did not meet my criteria that I use today for longs. Okay, so, we have to admit these things. And yet it was a huge contributor to my profit. It was at one point, I think, 400 or 500 ATR profit. The great thing about trend, is when you're trying to diversify a traditional portfolio, you got to stick with stocks, right, and bonds. They have a tendency to go up over time because we're just using buy and hold. And then all of a sudden gold, maybe if gold's strong, if you do the back test, gold has made money as well. But very few things can be added to the portfolio that are going to add diversification and not subtract from returns, i.e. they have a positive return. However, when you wrap trend following around it, everything has this positive return. Every markets are like the commodities, long only commodities, maybe some diversification, but I don't know if they just make money over time or not. Long only, right? So we do long and short, systematic. They all add diversification. They all add, 90% of the markets are going to show a profit. The other 10%, and that statistic of 90% of the markets being profitable when you use trend following, that could change in the future. It could become 100%. The ones who lost money may be the best performers in the future. So that's my mentality of not wanting to predict price and relying on trend. Yeah.
Yeah, one example of a market that always loses money is the future of VIX, because of the term structure of it. And yeah, when you apply a trend following system to it, you can make money there. It's just a bad way of making money with VIX. That there are better ways to get profits from that. But even a dumb system like trend following, one market can be positive on that.
But Bruno, can I ask you a question? Do you think it's true the statement? For example, when in 2007 I started reading papers, and I stumbled with Mevan Faber's paper in which he just opened saying, okay, applying a moving average, it will make you get equity-like returns with lower risk. So do you think that applying trend following in general gives you the same return as the underlying with less risk? Do you think that's something that holds more or less for everything that you put trend following on?
I think it depends on how you define risk. If you're talking just if you're treating risk as volatility, I'm not sure. I think trend following systems are maybe more volatile. But if you're treating as risk of ruin, I do believe that trend following is a really, really robust way of protecting you from ruin, especially if you're trading a lot of markets with small bets.
With the classic trend following, I wanted to get Michael to comment on this as well. I think he tweeted something that I found was pretty interesting, but I'll mention it at the end of what I want to say on this subject. I think with the trend following, you're not able to make comments about individual markets or sectors. We must look at all the markets as if they're the same, without personality or without any individual performance. And we run these systems on all the same systems on all the markets, currencies, commodities, stocks, bonds, long and short. And all we know after doing that is what the expectation per trade is. It's whatever the expectation is for all the markets. So there is nothing out there where you can say corn does this or stocks do that. It's the combination of all of them, because that's how we get our sample size. I think Bruno's correct, is that if you have a market like the stocks that have a tendency to go up over time, and as soon as you get ready to go short, they rally to new highs. When that happens, you absolutely are going to trade, the trend following system is going to have some failures because it's getting out. If you get out during a big bull market, then you're going to make less money than the buy and hold, and you have to trade a bit bigger, use your leverage to make up for that over time. And I'm not so sure that buy and hold performance is going to be very correlated to a trend following performance. Certainly, it can be much different, better, worse. And then, of course, the sizing, which is so important, based on ATR at the breakout, so it can be the size of the P&L can be much different than buy and hold. Oh, and I wanted just to say that I think that I can't find the tweet from Michael, but I think it had something to do with the fact that he was saying that there is no sample size when it comes to looking at these markets that have outliers are part of the performance, individual market outliers. And so I think Richard doesn't rely upon that idea either as much as other ideas. And so that's just the way I was brought up and raised, is that because we're treating all of these markets the same way, we can de facto include the markets that have the big outliers in the sample size. It's not analyzing performance and saying, oh no, because you have 5% of the trades that look nothing like the other 95, you cannot include those in your sample size. And the way that I was taught is because you trade them the same way, you can include them.
I think the strength of and beauty of trend following is this, that we apply to universal rules. And as I call it, we apply to the laws of nature. I call this because, in fact, I see the same in nature. So the same rules, the same laws. So it's very, very important to understand for all of us. And there is no reason to predict anything. Only applying those rules over and over again will make us winners in this game. 100% so, I'm sure.
Hi guys, can you hear me?
Yep.
Yes.
Hey Jerry, hey everyone else. Greetings from London. The weather is nice in London this week, so it's good. It's not a miserable weather out there. Interesting conversation that you were having. That I find it fascinating actually. In terms of indices, I think one of the main things to note is we cannot impact the price as hedgers, as producers, and as speculators. We cannot impact the price because and so this means that there is no human psychology impacting directly the indices, and I think that's one of the reasons why we are price takers with the indices. So there's always going to be, so it's maybe one of the reasons why it trends less compared to a single name stock. So that's something else that I wanted to raise. In terms of the stock trading, single name stocks, that makes a huge difference. Especially I definitely agree with Jerry in the sense that shorting large caps, is no brainer. Shorting large caps, large caps as if they have been made to be shorted. And going long for the small and the medium companies. So the risk of shorting small and medium companies is they might get acquired. And in my back tests, I'm seeing a lot of small and medium companies are being acquired, all right? And if you're shorting something else, and if the company is being acquired, then of course you're going to end up at the wrong side of that move, and you wouldn't want to be there. So there's a little bit more risk shorting the small and medium companies because of that. So that's a point to raise. In terms of the the stock selection bias, I'm using an index. So I don't think I do have a lot of bias. I'm sticking to an index, but I've added a little bit of discretion and, with a small risk, not a lot of risk, but, if, banks, if the medium-sized banks are going down the drain, it would be, I think, injustice not to trade them or just allocate a little bit risk to them, because my broker provides 14,000 stocks. I mean, the broker provides 14,000 stocks. Can you imagine? 14,000 stocks. And my broker provides 30 commodities. It provides, 15 bonds. It provides 200 Forex instruments and 14,000 stocks. So, I cannot. So I'm trading all the commodities, 30 of them. I'm trading all the. So I'm trading everything else, but it is just not possible to really to trade everything else in terms of the stock. So what are you going to do? So how are you going to deal with the stock selection bias? I mean, discretion, using an index, using a momentum helps, but I think if out of those 14,000 stocks, if you think that a pocket of the sector is moving, like these banks, so I mean, you might want to allocate a small portion of your risk budget as a discretion, because sometimes not only on the short end or the long end as well. If you notice Tesla is going up or Moderna, and if the COVID is happening, and if you're not adding pharmaceuticals that are going to produce the vaccine, I think you would. There's a potential that the upside is huge. That you would rather lose, some portion of your risk budget there, but include those pharmaceuticals into your companies, into your portfolio to trade. In terms of this year, the performance is really it's so far not going well at the back of last year's good performance for a lot of trend followers. So it's either you're flat or you're down. But one of the sectors that has made a lot of money is crypto. So in January, if you're trading, if you have a crypto segment in your portfolio, you're making good amount of money there. And if you're not, so why you're not trading crypto segment? It's just especially this year, it has made a lot of difference. So if you're not incorporating crypto, I suggest to incorporate some small risk budget to the crypto. It has made a huge difference in my tests, basically. And overall, when I look into the major household names in the CTA industry, like a lot of names are significantly down. Like Quantica is a very good example. That is they are significantly down, like 5%. But Malvern Capital is leading the brand on a year-to-date performance, like 27%. And I don't know what he's trading in this market to be able to get such a performance. I don't know what is trending 27%. What, yeah, is he's his performance is outlier at the moment. But there are lots of alternative markets, and that's one of the reasons why our performance also differs. One reason is stock selection. We trade different stocks, so the performance is different, and also there are some alternative markets. So that is another reason for the performance to be different as well. And finally, ChatGPT. ChatGPT is don't forget it's a black box, and I'm fine to use it so long as you can somehow recreate its calculations. If not, it's just not different than someone else is using algorithm, and that's not suggested, right? You wouldn't want to be using someone else's software, its code, its data. So you don't know where it's getting data, you don't know its code. So unless you can reperform its results, then I think it makes sense to use it. But otherwise, I wouldn't use ChatGPT as well. Anyhow, that's me this week. Thanks, guys.
Why are you suggesting people trade crypto?
Because
Corn will never go to zero. McDonald's will never go to zero. Apple will never go to zero. Coffee will never go to zero. Crypto can go to zero. It can hit an absorbing barrier due to regulation. It's highly speculative. It's reckless trading. And it's one thing to say, I like to trade crypto, and another thing to say, I'm suggesting to people trading crypto.
so, Michael, yes, of course, these are definitely not investment advice. Okay, so we are having a open conversation, and in my tests, allocating a small risk budget, like 5% to crypto, is making a difference because in 2023. So you're gonna ask which markets have trended, and January is especially a very big reversal month of the credit portfolio. So we made some good amount of money last year by trading from bond trading specifically, but that bond trade has been reversed this year, and especially from January through March, there has been some significant losses that you can see at the performance of major trend followers. So while you're going down in the credit side of the things, credit segment. So the obvious question is, what is trending? Okay, credit is not trending. What is trending? One of the things that has significantly trended this year is crypto. So you might say that I'm only going to trade Bitcoin and allocate some risk to it, or you may say I'm going to trade more than crypto. But as I mentioned, so my risk budget is 5% for crypto. It's not too much, but it makes a difference to trade all the asset classes in a super tight with a super tight risk management, I would say. Thanks.
5% allocation to an asset that has potential absorbing barrier is too high, very high.
Yes.
And
Maybe, yes.
and now for personal trading, it's fine. But someone who trades other people money, they should show respect, because tomorrow the CBDC comes out, they will outlaw crypto. The crypto will not stay around if the central banks issue the CBDC, because it will create arbitrage opportunities. They don't want this. So 5% for a fund is a huge allocation, maybe 0.2% or 0.3%, maybe maximum 0.5%. But 5% is a huge. Now, for a retail trader, fine, they can go 100%. It's their own money. They can do anything they want. But if you manage other people's money, you have to be very careful what we are doing. That's my point. Now, Jay, you talked about Tesla. Tesla had 6 drops of more than 10% since IPO, when the stock was six rallies of 10% when the stock was below the 200-day moving average. These things are very hard to trade. And also, I'd like to ask you something else. It's AUM specific, but at some point, ATR does not play any role if you trade many assets, because the allocation becomes 1/n. Have you reached that point?
Oh, I don't think I understand that. I mean, I think my goal would be to at the entry for each position to have the same risk and risk the same amount, normalize the losses. So I'm on purpose trying to make euro dollars and corn be the same bet and risk the same dollar amount and give each the same amount of room in terms of ATR loss. And then, yeah, so I'm all for that. I wanted to say too that I trade the Bitcoin futures. I think it's equally weighted, 1 out of 300 markets. I think losing all of your money in Bitcoin is definitely more likely, even though I don't think it's likely, but it's probably more likely if you trade cash Bitcoin versus, you get your wallet stolen or something like that, whatever that means. I'm not sure, but I trade the futures, and I think inherent to trend following is the idea that we, number one, will trade a lot of markets. So my crypto is, I trade the Ether futures as well. So 2 out of 300 equally weighted. And I'm going to go short. And I think that we see these markets all the time that have these massive sell-offs that you can't get out. The trend follower usually can get out, or almost all the time can get out before it goes to zero, let's say, or it doesn't even have to go to zero, suffers a huge loss. And then it gets short, and you actually make money if it goes to zero. But we see this happen not just in other markets. I don't know if you saw yesterday, or the day before this, Carl Icahn fund that's traded on an exchange. It lost a lot of money in one day. He lost 10 billion in one day. So, but this happens in equities all the time. And this is back to Richard's insight, which I totally agree with, that one of the biggest advantages of trading lots of markets is the small bet size. So even if things are correlated, it is definitely possible that one particular market in a group of correlated markets might have a very bad performance, and you'll be very happy that it was as small a bet as you could possibly make.
Yes, I would definitely agree with the smaller bet. So, so in terms of crypto, yes, I was trading a diversified markets, like 20 markets in the crypto space. So I've just tested it, by the way. I haven't put a lot of money on it, but it is, the whole advantage of what we are trying to do is the small bet size. So because it is a small bet size, I can sleep very easily. I think that's a major difference. So when you're, risking 20 basis points, 25 basis points on Bitcoin, or, whatever the chain link or whatever that is there, whatever the crypto space is, so it's just another segment. And what are and yeah, I think the chances of default is probably higher when you compare Ethereum or Bitcoin to something else a little bit less known, something Litecoin or Bitcoin Cash. You might lose possibly more money by trading Bitcoin Cash or Litecoin or whatnot. But if you're risking really 20 basis points, 25 basis points on a position, the chances of that happening at the same time happening is really, really low, unless there's a systematic risk. So this year, 2023, anyhow, so what is trending? So, there is some trends that are happening in gold. There's some trends that are happening in the agricultural sector. But I think overall, so far this year is, no one else is talking about performance this year. Richard is not talking about it. Jerry is not talking about it because there's not much talk about it. The things, the industry is not having one of these great years so far. And I was reading news about whether are we going to see a repeat of 2018. Okay. But I don't think this is going to be a repeat of 2018 because, there was a bear market in 2018. So far, we do not have a bear market. And so I'm keeping my hopes up, and this negative performance is going to come over. And, there's a good chance that in the second half of the year, maybe, things just good. Things may look better than they are looking at the moment. Thanks.
Don't talk it, not to jinx it.
Michael, can I ask you a question? When you were talking about absorbing barriers, etc., I kind of think I understand, but I'm not very intelligent to understand that much of what you mean. Do you mean that Bitcoin can go to zero on a gap? Like, for example, I don't know if overnight or 1 month or etc., but it can go from what it is to zero. And then what do you think will happen? I'm not speculating, but what do you think will happen to the futures part of the industry that it's already trading Bitcoin? Meaning, wouldn't that bring the whole CME down or something like that? I mean, every broker will have to go after clients because they will be losing much more than their equity on the exchanges, etc.
It won't make a dent to CME because the size of the market is very small. Bitcoin can go down to zero in a second if they decide to do that. I don't think they will, but the danger is there because of the talk of the central bank digital currency, the CBDC. Bitcoin and the CBDC cannot coexist because they will be rivals, and in case they decide to go full digital, the central banks, and I personally think they will eliminate the cryptocurrencies. They will find excuses. They will say, they facilitate crime and everything else. They want the CBDCs because they can program them to for resource allocation. For instance, they will tell you you can spend the money in that period, or you lose it. You can buy so much meat. You can use so much for vacation, and it will be, financial regulation. It will have some positive aspects, but more negative aspects related to the current situation. Some people are against. A lot of people are in favor of this structure because it will totally eliminate crime. Totally eliminate crime. Everyone will have personal money assigned to them, and they will know what you are doing and what you are spending the money on, who is taking the money, where the money goes, etc., etc. Okay, so I personally think we are moving towards toward that direction, and it will just take time. That's another talk. It's irrelevant to trend following. For instance, I'm looking here at my statistics for Bitcoin. Bitcoin has had 6 drops of more than 20% when 6 rallies, of more than 20% when it goes below the 200 moving average. These things cannot be traded. Whoever says that they are trend following Bitcoin when the annualized volatility was like 170%, it's all luck, what they made. Luck, pure luck, in my book. So that's the in general, when we're talking about absorbing barrier, we're talking about a situation when you hit a situation you cannot continue, everything finishes.
I'm not giving up on Bitcoin trends and using trend following on Bitcoin. But I wouldn't necessarily disagree that that you might be right. However, I would just say that I don't know if your answer would change, but, and I can't speak for everyone, obviously I don't, but for the simplest, most classical trend following, most of those things you mentioned don't come into play. Like, I put this position on, it's one out of 300, or, a lot of people trade 100 markets, and we use ATR, and it has nothing to do with percentages or that sort of thing. And we're totally willing in every situation to get out with a small loss. And that's like easy. That's easy. What's difficult is it goes up a lot and then it crashes, and then you get out with a small profit, or you end up taking the full loss. So that's no fun. But with loose pants trend following, with these 100-day plus breakouts, what's happening in these markets? They all look very. It all looks very bad. It's just not Bitcoin. Like, in order to get that, okay. So I think Tesla went 500 ATRs. Right after the breakout, it went up 50 ATRs. That's very healthy, very good trend. It gave it all back. The exits did not get elected. It went back up to new highs. And then the drawdown from peak was maybe 100 ATR. So that if Bitcoin is luck, then so is that. It's all luck, because if Bitcoin does that and even worse, it's a sample size of one. So I just think that the classic trend following approaches the markets in a whole different way, and it's objectionable to everyone who trades normally and not trend following. But it's not just Bitcoin. It's all of these markets. I mean, you'd be aghast at how far away my trailing stop is on major big profits. And I only do it because the back test says these are the best breakouts.
Well, I don't understand. If I recall, Richard said last week, I think, or 2 weeks ago, that in trend following, we place these positions and then we expect some luck to hit some outliers. Maybe I misunderstood, but maybe Richard wants to talk about this. I really liked it because Richard is more practical about trend following. So maybe trend following has a huge luck component built in. I don't know if I understood Richard well.
Yes, Mike. When we're dealing, the thing I've got my concerns is when we're talking about trend following, we've got to be very specific, because the particular form of trend following that Jerry and I are referring to is certainly not the same form of trend following as most of the other trend following CTAs are doing. We are specifically focusing on these outliers, and that therefore totally changes the game in relation to how we deal with correlations, how we deal with all of the traditional metrics, how we deal with volatility, how we deal with all of these things, which is a totally different game to other forms of trend follower. So the key difference I'm saying is that the outliers that we're dealing with are these non-linear anomalies. I'm specific about that because I'm thinking that other forms of trends, such as trending components of mean reverting cycles, are much more frequent than the outliers. So, if we look at, for instance, London sugar, which has had an outlier move in hindsight, we refer back outlier move from 2020 up to 2023. When you count the number of mean reverting segments in that London sugar, you've got about 10 or so moves over that period of time of up and down mean reverting cycles, which people on the shorter term time frame would clearly be dealing with trends. But We don't focus on them. We're using these very loose pants models that is looking at the directional extension of the trend as opposed to the cyclical nature of the up and down movements that you typically get in trend form. So because we are specifically focusing on outliers, our game totally changes. And this is where luck is involved. It's luck because we understand the principle of liquid markets is that they are non-Gaussian in nature, and that the prevalence of 5, 6, up to 10 or more standard deviation moves is much more frequent than what a Gaussian distribution implies. That's all we need to know. We need to know that something happens to the nature of trending price moves when you start getting towards the tail regions of the distribution of market returns. There is something driving these non-linear anomalies that's giving rise to these power laws. That's the only form of trend we're concerned with. And because of that, we don't have a profit target. Because of that, we have loose pants. However, other trend followers that are looking at mean reverting cycles, they'll be much more concerned with, when we get a volatility expansion, we'll put a profit target on that because then we'll take some of the profit off the table because the trend is naturally going to wane after that volatility expansion. We say no when we're out in these chaotic zones where the distribution becomes more couchy in nature or more Pareto in nature. We say we can't apply these statistical rules because we don't have the statistics to validate that, because these infrequent nonlinear anomalies are fairly chaotic in nature, and there is no formal distribution that can be applied to these nonlinear characteristics. We are applying luck in that we don't know when or where these events are going to occur. And so our entire process is sitting there waiting for these anomalies, which we can only declare in hindsight. We must therefore enter our signals when price direction becomes to an extreme level where most people are saying, the trend's going to revert. That's the time we're entering those trends, because we're deliberately trying to basically target the tail region for this distribution. So if you look at our trade frequency, the number of trades we take, we find that instead of displaying the properties of the normal distribution, because we are being very selective and only entering these very material price moves when prices get extreme, when there is a greater chance of nonlinear tendencies being expressed, our trade distribution approaches the properties of the tail region of the distribution of returns, not the bulk of the distribution of returns. And that therefore totally changes the ball game. So it's a game of luck in that, we never know whether we're going to catch them, but we know that the non-Gaussian nature of these liquid markets makes any liquid market a possible candidate, because we know that these symptoms occur in all liquid markets over the very long time frames, but we can never say how frequent or how big they're going to be. We just know that that is a characteristic of the behaviour of liquid markets at certain times, and therefore it is a process that we do, which is, it appears to be luck, but what we're doing is we're saying, let's diversify widely. And what we're doing is we're turning this statement of luck into a process where we're saying, if we diversify widely, we're going to be at the right place. And if we have our systems on 24/7 all the time, ready to pounce on these price extensions when they get significant or material in nature, that's the when, and the diversification is the where. We turn this luck statement into a process where we're in the right place at the right time simply through our process, which is a statement of luck.
And it's a very beautiful idea, and to apply universal rules to as many markets as possible. And of course, the more markets we trade, the better it is. I understand it I'm sure that it's 100% so. And it's very beautiful. Even looks beautiful, sounds beautiful to do this. And in the end of the day, we will be in a very big profit because of it.
Yes, so this is really, really nice. So the whole point is to be able to, trade a large universe and to risk small. So 100 markets, 25 basis point risk, and in my system, so some of my systems are holding these outliers like 5 days, okay? And of course, this is a little different than what Jerry and Richard doing, but it is, in essence, it's a different distribution. So there is not much difference in philosophy terms or in psychology to be able to trade 200-day breakout versus a 5-day breakout, which basically some of my systems are doing. So but the principles are the same. The universal parameter said a huge diversification. I would say as many markets as you can humanly and operationally trade. Jerry is trading 300. I'm trading at the moment. My universe is 100, but the more the better. I would say because you can risk smaller, and the smaller you risk on each of the markets, your risk of ruin is smaller, obviously. So that's definitely a positive thing. And in terms of luck, everything else we do in the short term is luck, but nothing is luck on the long term. So if a trend following system is having a 40% win rate, the outliers or the winners that you have in the short term is luck. But in the long term, it is almost 100% guaranteed that you're going to win. So it's not luck. So I don't agree that there is luck in the long term. But in the short term, yeah, everything else we do could be seen as luck. Thanks.
Well,
The way I view it is if you imagine, I often equate ourselves to being storm chasers. In other words, if we look at the meteorological data samples of the world, we find that there is a characteristic mean, median, variation, etc. when you're looking at the gross statistics. But we do know that at these episodic times, there are these significant storms that do occur. We know that occurrence is much more frequent than what the Gaussian distribution implies. We know that through just logic and looking and noticing the frequency of storms that hit us. We know that they're much more frequent than what the Gaussian distribution implies. So we're applying a process that doesn't know where those storms are going to be, but we are diversified widely across the world to capture them whenever they occur. And we're waiting for the winds to pick up to a material level where clearly there is a big storm front arriving, and which is clearly saying to us to enter that storm. But it's defying the principles of what large-scale statistics implies about the meteorology of this planet, unless you look at the tail properties of the meteorology. And if you look at the tail properties, which is a very sort of small segment of that data, you find that these non-linear power laws exist in these opportunities. There is serial correlation, which is often missed by people that analyze trends because they're looking at mean reverting components of trends or random trends. They're not looking at the non-linear trends that we're particularly targeting. So all of this debate we're getting, about, whether to apply dynamic position size, whether to do volatility, is all based on an assumption of using large-scale statistics, where we find that we don't have much legs to stand on because we don't have a large data sample to work with our non-linear anomalies. But I'm feeling confident that we're doing the right thing because we understand the mechanics that's going on, and we understand, through logic what is going on. We're just not necessarily relying on a back test or data samples or statistics to tell us whether that's fact or fiction.
Let's clarify a few terms. I think it's important. Most people know that, but when we are talking about the expectation of trading, we are talking about the mean of the distribution. In statistics, the expectation is the mean of the distribution. So for power laws, like in trend following, to have an idea of the expectation of the distribution long term means thousands of years. And it's easy to show that. Nassim Taleb has spoken and written about this in his books. When you have your average trade, it will converge to the expectation or mean of the distribution at the limit of sufficient samples. And for trend following, the limit, the sufficient sample is millions of trades. So in trend following, you don't know your mean. Now, why do you want to
Spot on,
know?
Mike. That is spot on. Very good point.
Thank you, Richard. Thank you. I know we agree in these things. I heard you speaking, and so
Off
when
mic
we're
there for a
talking,
while. I mean, towards the end.
yeah. So I
But
want to say that
I think it can look like luck. You know, a lot of people say, including Buffett and all the trend followers or classic trend followers, say, "Yeah, you take away my 5% of my best decisions, the 5, which represent a small percentage of all my decisions. You know, I wouldn't really have very much money." And I think someone who sells options, they can also be very comfortable that it's highly unlikely that they're going to get caught in a situation where an outlier wipes them out. Although almost everyone would tell them it's just a matter of time. And I think we're sort of saying the same thing. These trends are inherent in all the markets. It's just a matter of time before we get one. And we see them all the time. So it's not like, but I do think it takes a little bit of faith for the future always. And then maybe this is why the managed futures CTAs don't hunt outliers, because they see the numbers and they say, who wants to rely upon 5% of your trades?
So in terms of the point that Michael was saying, the sample size is not sufficient given for a future that is unknown and in unknown size. So if you have 10,000 trades in your sample, in the future maybe there is 1 billion trades. So of course, that's why what we are doing is only robust if we assume the sample size equals to the population size. All right. And what happens is, if you, on the moment that you relax that assumption, nothing is robust in what we do. So what are you going to do? Then you're gonna do all the things that possibly Richard is doing, and you're gonna adjust that portfolio and universal parameter set every year to be able to capture that additional data, because every year you have more data to look back while you're engaging with the uncertainty, and it is scary. It is scary because your average winners might change. Your winning streak might change, your losing streak might change, your maximum drawdown might change. So what are you going to do? So it means you're going to tweak your systems every year or frequently. And I think that's what happens with the trend following. So trend following requires this sort of gradual and continuous adjustments as we move along to the future. And this is one of the ways why it is different than investing. You cannot just buy it and forget it, basically. Thanks.
Yeah, Jerry, in the past I wrote an
Like I said, I
article
got cut
that,
off with Michael towards the end. But another thing to
Hey,
remember as
Jerry,
well. Yeah.
just one moment. I think Mike's trying to speak. I run with these issues frequently, Mike. What you may try is to switch to your audience and then get back as a speaker. Then I'll be able to hear you.
When we're talking about when distributions become couchy in nature, in other words, when we're out in the tails and we're taking sample distributions of the tail region, we find that there is no single mean. In fact, what we find is that with a Cauchy distribution, the mean effectively requires almost trending towards an infinite sample size with the central limit theorem to get to a single mean. But what that means is that we have a very special technique that we apply in that tail region, which is simply to cut losses short and let profits run. What we're doing is we're we're applying an asymmetry in that region, which, whilst we are harvesting luck in this area because we never know when these things are going to occur, we do know that they do occur with sufficient intensity and sufficient numbers over the course of large samples. We know that by applying this system rule of cutting losses short with a stop loss, small bets, and letting profits run to their conclusion, actually puts an asymmetry into the situation which effectively sort of resolves this conundrum of not having a single mean, not having an expectation. And that's why a trend follower like me, I can never know what I'm going to produce in 1 year, 5 years, or 10 years. I can't talk in terms of expectation when I'm dealing with outliers. But I do know that over the course of large sample sizes, I'm going to win over the long term because I know that the nature of these markets has this tendency to exhibit these universal tendencies.
So if we come back to the conversation, then whether it is luck, now on a 40% winning system, okay, the assumption is your sample size equals to the population size. So you're assuming that you're gonna continue to win 40% over the future. Then of course there is no luck, because if you win 40% of the times and if you can take all your trades, then you're 100% guaranteed to win as you move along in your trading journey. However, once you relax that assumption that you may not be able to win 40% because its sample size may be different than the population size, once you relax that, yes, then everything becomes luck. But it is not only for trend following. The entire speculation business becomes luck at that point. Thanks.
You may win 40%, but the payoff ratio may fall and your profit factor may turn below 1. And this may happen if the volatility of the trends increases and the stops start getting hit more frequently. And this is the problem. I wrote an article once that trends and trend following are not the same thing. The existence of trends does not imply profitability for trend following. There must be other conditions that make trend following profitable.
And also, I don't believe that we can apply an expectation formula to trend following. I think that the expectation formulas are only something really that can be defined in a stationary regime. As soon as that regime transitions, your expectancy equation falls out of kilter. Because the expectancy relationship is looking at your percent win, your return to risk, and these conditions change in different regimes. So under a non-stationary regime, there is no sense of any term of expectation over the long data samples because it depends how many regimes there have been in that data sample. So I tend not to like the use of data samples, but rather I tend to use backtests as the basis to try and develop my systems across as many different possible regimes as possible, because I could get a very large sample size over 6 months using high frequency trading. That just tells me about a single regime. But it's more important to me is how my system has been sufficiently robust over a myriad of different forms of regime, because that's more representative of non-stationary markets and this term robustness. I think expectation is something that really makes no sense to me in terms of my trend following, metrics.
Yes, but at some point the conversation gets scary, in the sense that, at some point we want things to be kind of robust. And, the more we talk about sample size, we're always coming back to the assumption that, let's say we are backtesting the last 50 years, okay, or, 200 years to the, 200, let's say we are backtesting last 200 years. And, of course, it's a very limited number of data available. So, and all these good conversation around 40%, the payoff ratio, 3-to-1 wins, everything else is around the fact that the sample size equals the population, different regimes. Okay, there could be different regimes, but, trend following is regime independent because you continue to get that 40% in different regimes. There was So really, your profitability changes in different regimes, different asset classes work. If you're diversified enough, you get back to that 40% anyhow. So go ahead, Michael.
Well, you see, the problem from a statistics point of view, and I want to hear also Richard, is whether you are sampling trades from a distribution of zero mean. This is one of the inferences you can make, but I think it's the most appropriate. And to know this, you have to have a very large sample, because if you are sampling your trades from a distribution with zero mean, that means that your long-term profit is zero. So how do you solve this? Jay has a good answer: diversify more, and I think Richard also, and risk management. You can't do anything else. And, you have to assume that non-stationarity, which is actually your friend. Non-stationarity is a friend of trend following, as opposed to what people say in other styles is an enemy. But in trend following, non-stationarity is a friend because it creates the trends. So you want the markets to be highly non-stationary. And if you have the good diversification and the risk management, you will win.
Great points, Mike.
Yeah, the one thing you don't want to do is you don't want to increase the number of parameters and number of variables and more rules to your system. That's the one thing I think, that's why we're so adamant about not doing that. I'm trying to get as many trades, individual trades, in my sample size as possible with, and I do it, ATR adjusted. So I'm always quoting, this trade went 50 ATRs, this trade went 5 ATRs. So I'm not looking at performance returns of the portfolio. I'm looking at thousands of trades in the back test. And of course, if you add stocks to your portfolio, you can get a lot more trades than just the futures.
And I also want to say that, yes, there is a huge difference between what Jerry does and what a retail trader can do. That's why many retail trend followers fail, because Jerry has this capability of posting collateral and he can size his trades with ATR. But a retail trader with a small account reaches the 1/n fast, and they cannot size with ATR. And I want to hear what Richard has to say about this.
Yes, Mike, I know you're not too fussed with CFDs, but what I do is I try and mimic exactly what Jerry does, but in the CFD landscape, I can certainly get down to micro lots, which allows me to trade very small positions. But of course, in my world, I've got a lot of things going against me, such as an impost of excessive trading costs and things. But I find that the power of diversification is sufficient for me to overcome the impost of those additional trading costs in my CFD world. Obviously, it's not the best world for me to be, but because I've got a limited capital, I'm unable to achieve what Jerry does. But I've got to achieve workarounds to try and achieve this level of maximum diversification, because really that's the only way I can see a retail trader surviving, by basically mimicking these processes of the CTAs, but recognizing their finite capital limitations, and what are the methods you can do to sort of try and combat that. And in my world in Australia, where CFDs are regulated and they're allowed, I can achieve that in my world. But I also sort of work for a fund manager down here in futures, and he hasn't got quite the level of diversification Jerry's got, but we're certainly heading that way. And we're finding, a lot of success in the process of which Jerry sort of teaches on this spaces. And so we're basically emulating particularly what Jerry does because we are focused on these outliers.
But there's lots of capability to trade fractional shares, ETFs, and I think that maybe you can't trade the futures as easily as trading the securities. And then, of course, brokers, IB, you can get 6-to-1 leverage or thereabouts. So I think that you can get quite a few stocks and currencies as long as you go the ETF route in interactive brokers. I think that people do this. I think Josh was talking about this earlier, that he trades fractional shares.
Right, Jerry. Robinhood is my pathway. They have no commissions, no fees per se, no minimums, and their minimum requirement for fractional is $1. So they have, I think it's 6 or 8 digits to the right of the decimal point, and it's easy. Every trade gets $1, and so when the underlying goes up 6%, so does mine. Mine's now $1.06, for example. So it's just a thing of beauty. Small scale experiment, but very affordable.
We've also got to recognise we've got a lot of counterparty risk in the products we trade with CFDs, and I suppose Robinhood as well. So counterparty risk is certainly something we've got to keep our eye on.
Do you know, guys, if the CFDs that Interactive Brokers do are against their own credit risk or the credit risk of others?
Typically, the way CFD brokers work is they have two types of shop. They've got what they call the B group and they've got the A group. The B group are basically what most retail traders get flung into, where the broker is very happy to take the alternate position to them and they make the market. But with the other group, they're the more serious traders who have a long-term track record. They're treated as a different group where they often have direct market access as opposed to the broker making the market for them. So brokers tend to break up their clientele into two forms, that which is going to lose money and those who are going to make money.
But in terms of credit risk, your counterparty is the broker or is another guy?
Usually it's a broker. So the way I overcome that is trade about 6 brokers. So with my programs, because it's all automated, I can sort of access across 6 brokers. So that's one way of sort of reducing to a degree the counterparty risk, but it's always there. So, one of you've got to undertake your due diligence to make sure that you're happy with the broker you choose, but that's something you've got to do for yourself. And but recognise that you are sort of in a tank of carnivores in our retail world of CFDs, and you do have to treat these things very seriously when you do your due diligence.
Thanks.
How's the slippage, Richard?
Slippage can be large. I was caught with the VPEG of the Swiss dollar that hit me, but at that stage I was trading, I think, at 50 basis points risk. So that slippage cost me 200 basis points or 2%. But because it was a highly diversified portfolio, it really was a sort of not a significant material impact, but certainly people who play with a lot of leverage, who don't have sort of small bets, aren't diversified, they usually get creamed by those sort of market moves. But slippage in our world of CFDs can be quite high, but because I'm trading medium to long-term timeframes with such loose pants, I'm finding that the degree of slippage that occurs in my CFD world is sort of non-material to me, but it's certainly material to those people that trade the higher frequencies.
Yes, yeah, that's very much so. And there are systems that I'm not trading because they are, from few minutes to few hours I can trade, and I'm not doing that because slippage is just like going out of the roof while trading CFDs, and also like CFDs is a huge opportunity for someone else trading 6 digits. How are you going to trade 100 markets with 6 digits? You cannot do that. So and in US, we've discussed this thing many times. Trend following is more of an elitist, way of investing, I would say. It's just, but in Europe, in Canada, we have CFDs so that we can take these small bets. So that I can risk 25 basis points. So it's a huge opportunity, really. But there are costs, yes, and the slippage is bad, and the quicker I get, okay, the more trades I make. So my hourly system is making like 12,000 trades per year, and I don't trade that because slippage is like quite a lot. But there is no limit in terms of taking these high frequency trades, because once you coded it, okay, once you coded it, you really don't care about it. The machine is taking those trades. Why do you care if it is 100 trades or 12,000 trades? Right? So you simply don't care. The only concern is whether you have an edge. Okay, you have an edge. Then the question is whether you're able to get that edge, whether you're able to extract that edge from the market, and of course, you're getting stuck with the broker. So there are better brokers to be able to do these things, and it is definitely possible. And I see that more and more people are going towards trading short term with the advent of technology, and I don't see that this is coming, or getting away. I think the algorithmic trading is the future, and the more people is going to do this API trading like I do, and it is it's definitely the future for me. But I might be wrong, but that's how I see it. Thanks.
Richard, thanks for the info. Have you ever had any trades CFDs cancelled?
No, Mike. No, but as I said before, it depends on what book you're on. I imagine that might be possible with the B book candidates, but as a professional trader, you tend to get slogged onto the A book, and that's more direct market access. So I've never had trades cancelled. No.
Nickel, right, guys? This year, last year, Nickel trade has been cancelled. It was a separate issue about nickel. Yeah.
Nickel. Yeah. Back in the day, back in the 90s, when the U.S. invaded Kuwait, I was out at an event and I called up my broker to liquidate some of my positions overnight. And I got out of the positions, and then the market crashed the next day, and or later that night. And the whole night I was thinking, like, man, are they gonna like honor these trades? Because they could just say, well, we don't remember you calling or whatever. And so I was so relieved the next day when they did honor them. But there have been other situations too. I think Singapore, Nikkei trade, I think the Singapore Exchange, or Nick Leeson. I grabbed all my money out of there as well when that was all going down. Okay, this has been fun. We'll pick it up again next Friday morning, 8 a.m. Eastern. Thanks, everyone, and have a good weekend.